Caesars Entertainment was once the undisputed giant of the Las Vegas Strip. Now, its empire is buckling under $12.3 billion in debt, a devastating $55 million quarterly loss, and a stock price cut in half. Being removed from the S&P 500 forced Wall Street to dump Caesars stock overnight, triggering desperate asset sales just to stay afloat. How did a casino titan fall this far, and what does its collapse mean for the future of Las Vegas? $12.3 billion in debt hangs over Caesars Entertainment, a burden that has become impossible to ignore. The company's financial statements reveal the damage in sharp detail. In the third quarter of 2025, Caesars posted a net loss of $55 million, which was 6 times worse than the same period a year earlier. Las Vegas, once its crown jewel, delivered just $379 million in adjusted EBITDA, a drop of nearly 19% from the previous year. These numbers are not just abstract figures on a spreadsheet. They signal a company under real and growing pressure, losing ground while rivals adapt. Since merging with Eldorado Resorts in 2020, Caesars stock has lost half its value. Investors have watched as the company's equity eroded quarter after quarter, falling far behind other major casino operators on the Strip. The debt is not shrinking. With every passing month, interest payments eat deeper into cash flow, and the room for error narrows. The losses are no longer a temporary blip. They are a warning that the old playbook no longer works. For Caesars, the financial pain is immediate and severe, and the margin for recovery is vanishing fast. On September 22, 2025, Caesars Entertainment lost its place in the S&P 500. That single event triggered a cascade of consequences. Index funds and ETFs holding Caesars stock had no choice but to sell, dumping millions of shares onto the market in a matter of days. The company's market capitalization, already battered, fell even further as forced selling accelerated the slide. Liquidity dried up. With less demand from institutional investors, Caesars' borrowing costs jumped almost overnight. Lenders grew wary, and the company's access to capital narrowed just as it needed cash the most. Under mounting pressure, Caesars began looking for assets it could sell quickly. Talks to offload the World Series of Poker brand and the Lion Q Promenade surfaced, both considered crown jewels in the company's Las Vegas portfolio. These were not strategic moves. They were attempts to raise cash and reassure nervous creditors. Proceeds from any sale would go straight to plugging holes in the balance sheet, not to fund growth or innovation. Every asset on the table signaled distress, not opportunity. In the eyes of the market, Caesars was no longer a blue-chip operator. It had become a cautionary tale, forced to sacrifice long-term value for short-term survival. Casino floors once packed with travelers now echo with empty space. In June, Las Vegas saw visitor numbers plunge by 11% compared to the previous year, a drop not seen since the darkest months of the pandemic. Hotel occupancy slipped by 2 percentage points, leaving thousands of rooms unfilled each night. The city, built on the promise of constant crowds, is struggling to fill even its most iconic properties. For Caesars, these shrinking crowds mean less energy on the gaming floor, fewer bookings, and a growing sense that the Strip's magnetic pull is weakening fast. Quarterly revenue reports reveal how quickly the downturn is draining Las Vegas. In the second quarter of 2025, revenue across the Strip fell 3.7% compared to the previous year. For Caesars, That meant tens of millions of dollars simply vanished from the balance sheet. Hotel rooms tell the same story. 27,000 fewer room nights were sold in just 3 months. Each empty room represents lost spending at restaurants, shows, and casinos. Money that used to flow through every corner of Caesars properties is now gone. The financial impact goes far beyond headline visitor numbers, eating away at the core of the business. Visitors checking in at Caesars properties now face a wall of extra charges. Self-parking costs $25 a day, while resort fees have climbed to $55 per night, even at value hotels like Flamingo or Horseshoe, where those fees used to be under $30. Guests booking a discounted room discover another $50 in nightly surcharges before they even set down their bags. These hikes aren't just frustrating, they are driving people away. The pain is felt especially hard by travelers from California and Canada, both key markets that are now shrinking. Instead of flying to Las Vegas, many are choosing regional casinos closer to home, or they are just gambling on their phones. The sense of being nickel and dimed has turned what was once a getaway into a source of resentment, eroding the steady demand Caesars once took for granted. Caesars has responded to shrinking crowds and mounting debt with a flurry of discounts and promotional campaigns. The fabulous 5-day sale slashed hotel rates across the Strip, while new offers targeted Southern Nevada residents with exclusive dining and room deals. Advance booking discounts now appear at nearly every Caesars property, marking a clear shift from earlier pricing strategies. Chief Executive Officer Tom Reeg, on recent earnings calls, maintains the company is set for recovery. He highlights a pipeline of convention bookings through 2026, calling group business the key to renewed momentum. Caesars is also pushing digital growth, reporting gains in online betting and iGaming as a buffer against declining casino traffic. Reeg argues these moves show Caesars can adapt to changing times. Yet the question remains whether promotions and digital bets can truly fill the gaps left by empty rooms and wary travelers. Las Vegas gambles on endless demand. But when trust cracks and prices soar, even icons can fall. The Strip's future now hinges on who's willing to pay and who walks away.